Hello everybody, and welcome back to Dr. Luxurious. Today, our video is about billionaires and where they keep all their money. If you're new here, welcome to our channel. Please subscribe and click the bell icon for more interesting videos. We all know that billionaires do not keep their money in one place. They definitely don't have a large savings account sitting around with $1 billion in it. That's because inflation risk hurts the rich most of all. To keep their wealth from being worth less every year due to inflation, they need to put it to work by several means. Let's see what they do with their money. Number 1. Real estate investments. Following the housing market crash and the recession, investing in real estate to protect against recession might sound dicey. But the wealthy can afford to invest in commercial properties, specifically multifamily and storage units investing, directly or through REITs, also known as real estate investment trusts. One way to invest in real estate is through crowd-funded real estate investments, which pool funds from many investors to invest in commercial and residential real estate. Many of these investments are only available to accredited or wealthy investors and may provide high returns. While they add diversification, the risks of real estate investing remain. Number 2. Owning put options. A put option gives the holder the right to sell a certain asset at an agreed-upon price in the future within a fixed time frame. The buyer of the put option expects the underlying asset, say a stock or currency, to depreciate in value below the strike price before the option expires. If the price of the underlying asset indeed drops, the value of the option increases. The options themselves can be traded, protecting the investor against a drop in the asset's value. If the price does not fall, put option buyers stand to lose what they paid for the option. Because put option is not direct investment, but derivative financial instrument, which is a contract related to the value of the underlying asset, it is significantly more speculative. While put options are available to smaller investors, such a hedging strategy is more often suited to larger portfolios managed by the wealthy and the professionals. Number 3. Owning defensive dividend stocks. In case of a recession, investors need not divest all their stocks. Instead, they may opt for high-quality, defensive, dividend-paying stocks. Defensive stocks are stocks in companies that are generally less vulnerable to recessions and market downturns due to their less cyclical nature. Companies that operate in such fields as food, healthcare, utilities, and non-durable consumer goods tend to have more stable earnings. Defensive stocks often pay a dividend, which further protects investors during a recession and increases the portfolio's returns. Dividends can also provide a hedge against inflation, as companies that regularly increase their dividends would likely continue to increase the dividend, providing some protection against inflation, especially when compared to other fixed income instruments. Number 4. Investing in hedge funds. For wealthier individual investors who can afford higher fees and risks of hedge funds, investing in such funds can help protect against losses typical during a recession. Hedge funds pool funds from investors and invest in different securities. Because they are less regulated by mutual funds, they are free to use riskier strategies such as short positions. Hedge funds are limited to wealthier and institutional investors. Hedge funds are designed to make money regardless of market conditions. While hedging is a strategy that attempts to reduce risk, the goal of most hedge funds is to maximize return on investment, often by using many highly risky investment strategies including derivatives and leveraged investments. Investing in hedge funds is a good way for the wealthy to diversify their portfolios. Number 5. Investing in private equity funds. Unlike hedge funds, which seek short-term returns, private equity funds look at the long term, 10 years or more. Managed by private equity firms, these funds are investing their pooled money directly in companies, either by purchasing private companies or a controlling interest in publicly traded companies and actively helping to manage them, or by making minority investments in fast-growing companies or startups. Their aim is to better realize the potential of the purchased companies. Like hedge funds, private equity funds are only accessible to accredited investors. These funds frequently use debt to acquire financially distressed companies. In the previous recession, private equity funds showed resilience, and nowadays larger investors are already shifting funds to private equity. Number 6. Gold. Gold has always been considered a safe haven instrument. The precious metal was even used to back currencies for some time. The United States abandoned the so-called gold standard in 1971. As a physical asset, it is assumed that gold will always retain some of its value, unlike paper money, even in bad times. In a recessionary inflationary environment, where the US dollar may lose its value, gold can preserve wealth and be used as a hedge against a declining dollar. In such times, gold is often a good investment in that it can appreciate in value. Holding gold also provides protection in case of political uncertainty. There are many ways to invest in gold, beginning with jewelry and actual gold bars and coins for direct exposure and ending with gold ETFs and gold mining stocks. Buying gold bullion is one method for high net worth investors to more directly invest in the metal. Investing in gold helps diversify a portfolio, and some gold stocks also pay dividends. In the case of a recession, investors can be doubly hit from currency risk. First, the domestic currency can lose value. Second, investments in other currencies such as the euro, the British pound, or the Mexican peso, or in assets held in other currencies such as foreign stocks, bonds, or real estate, may be exposed to foreign currency fluctuations. So, if you were a billionaire, which options would you choose to keep your money safe? Do share your thoughts with us in the comment section below. Hope you enjoyed the video.